If you're a small business owner and you've ever Googled, how much is my business worth? You've probably seen a bunch of generic answers. Things like 2 to 4 times earnings, use an online calculator, or speak to a business broker. See, the problem with these answers is that none of them actually help you understand what is really going on. So I'm doing a 4-part series that's going to fix that. In this series, I'm going to walk you through the 3 approaches that every business broker, appraiser, and buyer uses to value a small business, as well as a 4th approach that most brokers won't talk about. In part 1, this video, we're covering the market approach. This is the most commonly used valuation approach, and honestly, if you're only going to learn one, make sure that it's this one. In parts 2 and 3, I'll take you through the income approach and the asset approach, 2 of the other standard valuation methods. Finally, in part 4, I'll walk you through the returns approach. This is the one that most brokers won't talk about, but that every sophisticated buyer is using when they look at your business, so make sure you stay tuned for that. I'm Ed. I'm a business broker and the founder of Sundance Financial. We help small business owners sell their companies all over the US. If you like this video, make sure you hit subscribe so you don't miss any of our updates. With that being said, let's get into it. The market approach works exactly like a real estate appraisal. You look at what similar businesses have actually sold for recently, and you use that data to estimate how much yours is worth. Here's how it works in practice. Business brokers will look at thousands of recent business sales to identify businesses similar to yours. That means similar industry, similar size, and similar geography. They'll then use that information to calculate what's called a valuation multiple. A valuation multiple works just like the value per square foot metric you might see in real estate, only instead of square footage, we look at business earnings. Put another way, the valuation multiple is simply the ratio of a business's value to the earnings that it generates. For business owners, this multiple answers the question, for every dollar of earnings that my business produces, how much are buyers generally willing to pay? If the valuation multiple is 3 times earnings, that means that for every $1 of earnings that my business generates, a buyer would be willing to pay $3 on average. Now, one question I often get is which earnings metric should we use? There are a few of them to consider. There's revenue, there's EBITDA, and there's SDE, just to list off some of the common ones. I'd say that for small businesses doing under 5 million in sales, where the owner is still heavily involved in day-to-day operations, the standard metric to be used is seller's discretionary earnings, or SDE. I'll drop a link to a more detailed video explaining SDE in the description, but essentially you can think of it as your business's pre-tax profit plus your salary plus any personal expenses that you run through the business. That's things like personal insurance, travel, meals and entertainment. SDE gives a buyer a sense of the total economic benefit that would accrue to them if they were to purchase your business. I'll be posting a whole separate video on how you can use your tax returns to calculate SDE, so make sure to subscribe to my channel so you don't miss that. Now let's make this a little bit more concrete. Suppose you own a landscaping company, and your SDE, after adding back your salary and your personal expenses to your business's earnings, is about $300,000 per year. You look at similar landscaping businesses that have sold recently, and you find that they've traded at about 2.5 times SDE. 300,000 times 2.5 equals 750,000. That's your estimated market value. Now that multiple, the 2.5 times, isn't just a magic number. It can vary widely by industry. For example, restaurants might trade at 2.3 times, medical practices at 2.6, and machine shops might trade closer to 3.7 times SDE. I'll put a link to a full table with valuation multiples by industry in the description, but the point is that the market approach is grounded in real data. It's what buyers have actually paid for in recent transactions, and it gives you actual evidence of what the market will value your business at. And that's exactly why I like it. The market approach is practical, simple, and evidence-based. On top of that, it's what buyers and their lenders are most likely going to use to assess your business. So there you have it. That's the market approach. And like I said, if you only learn one valuation method, make sure this is the one. In part 2, I'm going to walk you through the income approach, also known as a discounted cash flow analysis. Using this method, we look at your business's future earnings potential as opposed to what other similar businesses have sold for in the past to determine value. Now, if you found this video helpful, you can do me a favor and hit subscribe. I'm building out this channel to give small business owners the straight, practical talk on valuing, preparing, and listing their businesses for sale. You can also check out my video explaining SDE by clicking here. And if you're seriously thinking about selling your business and want to talk through your specific situation, I offer a free, no obligation consultation. Just book in via the link in the description. Again, I'm Ed from Sundance Financial, and I'll see you in part